California enters 2026 with a median home price forecast at $905,000, a new record, yet only a 3.6% rise from 2025. Sales are projected at 274,400 units, up just 2% from the year before. The Housing Affordability Index inches to 18%, meaning fewer than 1 in 5 households can buy a median-priced home. Mortgage rates dip to 6.0%, the lowest since 2022. The stakes are clear. Buyers, sellers, and investors all want to know, will California crash or recover? The California housing market does not move in a straight line. It swings in cycles, booms, stalls, corrections. In 2021 and 2022, sales surged, fueled by ultra-low interest rates and pandemic migration. That frenzy pushed median prices into the stratosphere. By 2023, momentum slowed. In 2024, the California Association of Realtors recorded 269,200 single-family home resales. In 2025, sales slipped slightly to 269,000 units. Now for 2026, the forecast shows a cautious rebound. 274,400 homes sold, a 2% gain. Prices tell the same story. In 2024, the median California home cost $865,400. In 2025, it nudged up only 1% to $873,900. But in 2026, CAR expects a sharper increase, $905,000, a 3.6% rise year over year. That sets a new record, yet the pace is far slower than the double-digit jumps of the early 2020s. The market is no longer overheated. It is stabilizing. Why does stabilization matter? Because California housing has been dominated by volatility. During the boom, multiple offers, cash bids, and waived contingencies became the norm. Buyers were outmaneuvered. Sellers dictated terms. But by 2025, the frenzy was gone. Instead, sales flatlined, affordability hit historic lows, and buyers waited. The 2026 uptick signals a shift, a market catching its breath, edging back toward balance. Inventory plays a central role. For years, listings were scarce, often down 30–40% from pre-pandemic averages. That scarcity kept upward pressure on prices. The forecast for 2026 expects a 10% rise in active listings, bringing supply close to pre-2020 levels. More homes on the market means more leverage for buyers and more competition among sellers. It means choice, a word absent from California real estate for half a decade. Migration trends remain a hidden driver. Tens of thousands of residents left California between 2020 and 2024, chasing affordability in Nevada, Arizona, Texas, and Idaho. That exodus eased some demand, but reshaped the buyer pool. High-income households, investors, and dual-income professionals remain the dominant purchasers. For them, a $900,000 home is achievable. For many middle-class families, it is still out of reach. The setup for 2026 is therefore a paradox. Prices rise to records, yet at a slower, more sustainable pace. Sales increase slightly, but the frenzy is gone. Inventory improves, but affordability still excludes 4 out of 5 households. The California market sits between two identities, no longer overheated, not yet affordable. The question now is who will step in to buy, and what risks will shape the year ahead. The California Association of Realtors forecast makes one truth clear. Demand is shifting. In 2024, only 16% of households could afford a median-priced home. By 2025, the figure edged up to 17%. In 2026, affordability improves slightly to 18%. That still means more than 4 out of 5 households are locked out. Demand is no longer broad-based. It is narrow, concentrated among those who can still compete. Mortgage rates play a decisive role. In 2024, the average 30-year fixed rate stood at 6.7%. In 2025, it dipped to 6.6%. By 2026, the forecast expects 6.0%, the lowest in 4 years. That drop translates into hundreds of dollars in monthly savings for finance buyers. It nudges affordability upward. It brings some sidelined households back into the hunt, but only those with strong credit and stable incomes. Who are these buyers? Primarily dual-income professionals in tech, healthcare, and finance. They earn enough to manage higher mortgage balances, even in high-cost counties like Los Angeles or Santa Clara. Investors also remain active, though their strategies have shifted. Instead of flipping, many now pursue long-term rentals, betting that California's population base and housing scarcity will support rental demand indefinitely. Cash remains king. In competitive submarkets like San Diego and San Francisco, cash offers bypass lending delays and insurance hurdles. Investors with liquidity dominate here. Meanwhile, younger buyers and first-time households lean on financing, often stretching debt-to-income ratios to qualify. That creates fragility. If rates tick back up or job growth slows, these buyers are most exposed. Economic currents shape the buyer pool further. U.S. GDP growth slows to 1% in 2026, down from 1.3% in 2025. California's non-farm job growth stalls at 0.3%, with unemployment forecast at 5.8%. Incomes rise slower than costs. Inflation runs at 3%, eroding purchasing power. This creates a squeeze. Buyers may qualify on paper, but in reality, monthly costs eat into discretionary spending. Only households with higher resilience step forward. The anatomy of demand in 2026 looks like this: fewer first-time buyers, more repeat buyers, and a heavier concentration of investors and high-income earners. Financing costs improve slightly, but affordability remains a wall for most. For every headline about recovery, the numbers show a narrower market. And in California, that means stability rests on the shoulders of a smaller, wealthier buyer class. The forecast highlights a hidden force weighing on California housing: insurance. In 2026, carriers continue retreating from wildfire and flood-prone zones. Premiums climb. Buyers discover that approval for a mortgage means nothing if they cannot secure coverage. CAR warns of a home insurance crisis as one of the mounting headwinds facing the market. For many households, premiums rise faster than mortgage costs. A half-point drop in mortgage rates saves a few $100s each month. But new insurance quotes can add that savings right back, and more. In some fire-zone counties, annual premiums have doubled in less than 3 years. For a $900,000 home, that can mean $5,000 to $7,000 a year, or nearly $600 per month, just to ensure the structure. Insurer exits compound the shock. Major carriers announce withdrawals from certain zip codes, citing wildfire exposure. Others cap new policies. This leaves buyers with one option: the California Fair Plan. That plan, meant as a last resort, carries higher costs and limited coverage. In practice, it reduces affordability further. A buyer may qualify on income and debt ratios, only to be denied by underwriting once insurance fails. Sellers feel the pressure too. Homes in high-risk zones sit longer on the market. Days on market extend not because of lack of interest, but because deals collapse at the final step. Lenders require coverage. Without it, transactions are cancelled. Liquidity evaporates. The forecast notes that insurance hurdles are now as critical to market function as rates or inventory. This is not an isolated issue. California's broader housing sentiment is shaped by these risks. CAR chief economist Jordan Levine stresses that housing sentiment will improve in 2026 as rates decline. but only if uncertainty around insurance and other external shocks clears. Without that stability, every transaction carries an added layer of doubt. Insurance also intersects with equity. A buyer paying $905,000 for a median home expects stability. But if premiums keep rising, net ownership costs move higher than forecast. That squeezes monthly budgets and reduces future buyers' willingness to pay top dollar. In effect, premiums act like a shadow interest rate, raising the cost of capital without changing mortgage markets. CAR lists the insurance crisis alongside other macro headwinds, trade tensions, and the possibility of a stock market bubble. Yet unlike global issues, insurance bites at the household level. It stalls deals, it reshapes affordability math, and it concentrates risk, the very regions that need stability most. Rural, inland, high-risk counties face the harshest exit of carriers. The lesson is blunt. In 2026, securing financing is only half the battle. Securing insurance is the other half. Without both, the California housing market cannot function. That fragility defines the year ahead. Affordability remains California's toughest barrier. Even with easing mortgage rates, the cost of ownership in 2026 stretches most households to the limit. The Housing Affordability Index rises from 16% in 2024 to 17% in 2025, then to 18% in 2026. That means fewer than 1 in 5 families can afford a median-priced home. Improvement, yes, but still historically low. Start with the price baseline. In 2024, the median California home sold for $865,400. In 2025, it rose slightly to $873,900. For 2026, the forecast calls for $905,000. That's a $3,960 jump in 2 years. Spread over a 30-year loan, it changes monthly payments only slightly, but combined with insurance, HOA dues, and property taxes, the load is significant. Now layer in mortgage rates. In 2024, a 30-year fixed loan averaged 6.7%. In 2025, it eased to 6.6%. In 2026, the forecast places it at 6.0%. On a $905,000 home with 20% down, the principal and interest payment runs around $4,350 per month at 6.0%. Compare that to roughly $4,500 the year before at higher rates. The rate relief saves buyers about $150 per month, but price growth claws much of that back. Add property taxes. At California's average 0.7% effective rate, a $905,000 home means about $6,335 annually or $528 monthly. Add HOA dues, often $250 to $400 per month in suburban developments. Add insurance, rising to $400 to $600 per month in high-risk areas. Together, the monthly outlay easily tops $5,500, and in some counties exceeds $6,000. Now contrast this with income. California's median household income hovers around $91,000. Divide that by 12, and gross monthly income is roughly $7,600. A $5,500 housing cost equals 72% of monthly income. Traditional lending standards cap front-end ratios near 31% to 35%. The math shows why only 18% of households qualify. For the majority, ownership remains out of reach. Inflation compounds the gap. CAR projects consumer prices rising 3% in 2026, up from 2.8% in 2025. Gas, groceries, and utilities erode disposable income. Even as mortgage rates fall, the average household cannot reallocate enough spending to cover housing. The affordability squeeze is structural, not temporary. For those who can buy, affordability math still dictates behavior. Buyers trade location for price, shifting inland to Riverside, Sacramento, or the Central Valley. Others downsize, purchasing condos instead of single-family homes. Some extend commute times, betting that remote work flexibility offsets travel. The arithmetic reshapes demand patterns, not just ownership rates. In short, the 2026 forecast gives modest relief, but not a solution. Mortgage rates at 6.0% soften the monthly blow, yet record high prices and rising insurance cancel much of the gain. The affordability index at 18% remains historically low. California's housing recovery, if it comes, will not be broad. It will be selective, limited to those who can navigate the math. Liquidity defines the health of a housing market. It measures how quickly homes listed translate into homes sold. In 2024, California's sales volume stood at 269,200 units. In 2025, nearly unchanged at 269,000. For 2026, the projection rises modestly to 274,400, a 2% gain. But behind those numbers lies a more fragile story: transactions collapsing, contracts cancelled, and buyers frozen by uncertainty. Inventory finally shows improvement. After years of scarcity, active listings in 2026 are expected to be up by nearly 10%, approaching pre-pandemic supply levels. More listings should mean smoother transactions. Yet the opposite often happens. More choices bring more negotiation. Buyers push for contingencies. Sellers wait longer for firm offers. Days on market creep upward. What looks like liquidity is sometimes delay. Deal cancellations are another indicator. In wildfire-prone regions, transactions unravel at closing when insurance cannot be secured. In coastal flood-mapped areas, lender approvals expire while buyers scramble for new coverage. CAR warns that the insurance crisis is now a structural headwind for housing. Even with inventory on the rise, completed sales lag. The gap between signed contracts and closed deals widens. Financing fragility adds to the crunch. With median prices forecast at $905,000, even a small rate change shifts debt-to-income ratios. At 6.0%, monthly principal and interest run about $4,350 on a median home. If underwriting tightens, buyers fall short mid-process. Transactions fail not because of interest, but because affordability thresholds move against them between offer and close. Liquidity also varies by region. Coastal metros like San Francisco and Los Angeles face ultra-high entry costs, where fewer buyers qualify. Inland counties such as Riverside or Sacramento see more listings but also more cancellations as affordability gaps and insurance hurdles hit working-class households hardest. The overall state trend, slightly higher sales, is the average of these uneven realities. CAR economists stress that housing sentiment will improve in 2026 as mortgage rates decline, but sentiment does not always translate to liquidity. Confidence may rise, yet completed transactions lag if households cannot clear the insurance and affordability obstacles. The liquidity crunch shows up as friction, longer escrows, higher fallout rates, and rising frustration among both buyers and sellers. The lesson for 2026: more listings do not automatically mean more liquidity. California faces a paradox. Supply expands, sales tick upward, but deals fail at higher rates. The market appears healthier on paper, yet beneath the surface, fragility remains. Every cancellation, every stalled escrow, is a reminder that liquidity depends not just on prices and rates, but on the ability of households to close under real-world constraints. California's housing market is never insulated from sudden shocks. In 2026, the biggest threat is not just rates or prices. It is the trigger events that can stop transactions cold. The California Association of Realtors warns that insurance failures, trade tensions, and even a potential stock market bubble are all real headwinds. Wildfires remain the most immediate risk. A single blaze can redraw hazard maps overnight. Insurers suspend new policies, leaving buyers in escrow with no coverage. Lenders refuse to fund without proof of insurance. Within hours, deals collapse. Families expecting to close are pushed back to square one. Liquidity drains, not over months, but in a single week. Flood zones carry the same effect. Federal flood map updates trigger mandatory coverage. Premiums spike by thousands of dollars annually. For a household balancing payments on a $905,000 home, the unexpected insurance bill shifts affordability out of reach. Even if mortgage rates fall to 6.0%, the premium shock pushes costs above safe thresholds. Buyers walk, sellers scramble. The triggers extend beyond natural disasters. CAR highlights global trade tensions as a mounting headwind. Tariff escalations ripple into California's economy, slowing job growth already forecast at just 0.3% in 2026. When employers pause hiring, buyers lose confidence. Escrows in progress stall as households hesitate to commit long-term debt in an uncertain job market. Financial markets add another freeze risk. The possibility of a stock market bubble, flagged in the forecast, creates volatility. Wealthier households relying on portfolio income hesitate. In coastal metros where jumbo loans dominate, one correction in equities can erase down payment funds overnight. Offers are withdrawn. Sellers face sudden gaps in demand. These shocks ripple unevenly. High-risk counties see the worst insurance freezes. Tech hubs feel equity market swings first. Inland working-class markets feel trade and job shocks faster. Yet across all regions, the impact is the same. A fragile market stalls on a dime. The recovery forecast for 2026 assumes stability, but every shock threatens to unravel that balance. In short, California housing in 2026 lives under constant threat of freeze. Fires, floods, insurer withdrawals, global trade, or financial volatility, each can bring transactions to a halt. The lesson? The forecast numbers look steady only if the triggers remain quiet. One flare, one headline, and stability disappears. California's housing market is shaped as much by policy battles as by economics. In 2026, the tug-of-war among state legislators, city officials, regulators, and lenders defines how stable or unstable the market feels. The forecast calls for modest improvement. Sales up 2%, prices up 3.6%, affordability at 18%. But whether those numbers hold depends on governance. State regulators emphasize insurance reform, with carriers exiting wildfire and flood-prone.